Hello, everyone. This is Mike from Marlin Financial Advisors. Let's discuss the 5 ways to plan for market crash in retirement, and specifically, I'm talking about stock market crashes, right? So the first thing we can do is we can reduce investment risk of our portfolio. So if you're heavy into stocks, maybe we reduce that a little bit. And here's some options here. So you could go into fixed income products. That's what this first bullet is: CDs, treasuries. Since they're yielding decent amounts right now, fixed income is actually paying 4 1/3 for 10-year treasuries. I can show you the yield curve right here. 10 years paying 4 1/3. Shorter maturities are paying 4.46 and up. I wouldn't really go longer than that, but that's a decent option there. CDs are similar, but usually they only go out to 5 years and they're through banks a little differently, but decent options there to take away maybe some of that equity exposure and shift it into some of these options. Income annuities are similar to fixed income returns wise. So really an income annuity, the life insurance company takes your money, puts it into 30-year treasuries, which we know are paying about 4.4. So you could expect 4.4% return on your money in theory. And then they pay that back to you over your lifetime. Obviously, the main thing with income annuities are the main benefit is the longevity risk, right? If you die early, they stop payments. If you live longer, say 100, they have to keep paying you. So the longer you live, the better the return looks, right? But income annuities would be similar to a fixed income piece, returns wise and kind of the stability wise, as CDs and treasuries could be too. Okay, so next bullet, if you don't want to go into fixed income, you could also reduce your risk in your equity portfolio, right? So lower risk stock market sectors, just such as consumer staples and utilities. Let's take a look and see what I'm talking about. So right now, I have XLP, which is consumer staples, XLU, which is utilities, and then the broad market here, S&P 500. And I'm going to show you how they did in 08, okay? And I'm going to show you some income too from them. We're going to look at the dividends. These, obviously, you could pick other ETFs or mutual funds that track the same sectors, but these are the two kind of lower risk sectors, you could say. Now, it's more risks than fixed income, but relative to the total stock market, it's lower, right? So, and you can see this with standard deviation is a measurement of risk. The S&P 500 is at 16, utilities is down to 15, which is actually a much lower, except for recently, there's been a lot of volatility with rates, and consumer staples is down there all the way at 13. So we can see in 08 over here, blue, which is the S&P, got beat up the most. Red, a little bit better off. And then yellow actually did the best. So consumer staples only lost. We started about 10,000 in 08. Consumer staples went down to 7,200. So that's what, a loss of 28%. The overall market was almost at 50%, and then utilities was at 40%. And then they recovered nicely, right? So that's just showing you, in 08, consumer staples was only down 28%, right? So that's kind of something nice to look at. Our 30, let's round to 30%, sure. Now I want to show you income because this is key. So in 08, we have about $183 from S&P 500, and it goes down to about 152, right? The dividend actually dropped about 23%, I think it was, something around there. But if you look at the red line, which is utilities, it did not go down. 295, 317, 331, 371, 408. So you can see, even though the price of the security went down, the income derived from it was steady all the way through here, right? So that's something nice to look at too, is, well, okay, the stock price might go down, but the dividends are more secure, so that gives me a little more comfort, right? If I build a portfolio aiming towards income. Same thing with consumer staples. We got 229 dividend, 262, 283, 337, right? And it keeps going. There was a $4 dip here, 12 to 13, but you can see even through horrible market crash, the dividends stayed consistent, much more consistent in these safer, called defensive sectors of the S&P. So there you go. Let's take a look. What else we got? So we did some lower, and then building the income portfolio. I talked about dividends, right? So an income portfolio usually, right? Even the stock market was down 50%, but the dividends were only down 25 or 30%. So you can see if you build a portfolio that takes advantage of portfolio income or dividend income, it won't fluctuate as much as the total stock market will. So if you can handle a 20% dip in the dividend piece, then you can do pretty well. You can feel more comfortable in your retirement. And at the same time, not take away from principal. So, okay, so we're done there. Let's see, page number 2, take Social Security early. So the main concept here is just, well, if you took Social Security early, there's less pressure on your portfolio to make, right? So say you needed 80 grand a year without Social Security. After Social Security, you get 40 from Social Security and you need 40 from your portfolio. You now need to draw less from your portfolio. So therefore, if a market crashes early, you don't take as much out and you don't dig yourself a big hole, right? Simple. 3. So that's taking that kind of example and bringing some more complexity and strategy here. So using Social Security as a backstop. This is where you let the markets decide when you're going to take Social Security. So if the market's doing really well, let me take a look at this. You retire in, let's change this. You retire in, well, let's do 06, right? You retire in 06. And let's just get one of these up here so we can show and we can see what the market did. So you retire in 06. Let's go 06 to, let's zoom in here to 2011 just so we can see what's happening. When the market does well, you would keep, right, it's doing well here. You'd keep deferring Social Security and letting it grow. And then once a market drop happens, instead of taking from your portfolio, you turn Social Security on. So the reason we want to defer, right? Let's take a look at this. So at 62, we get about $1,700. If we can defer all the way to 70, if we can get 8 good years of stock market returns, we can basically double our Social Security benefit. So the theory here is, well, we want to defer as long as possible, but sometimes that's not possible because our portfolio is not big enough for different things like that. But here, like think 06 to 07 and right here at peaks, you made a little bit of money there. So let's go right to 07 here, 06 through 07. You made on average 10% over those 2 years in 06 and 07. So if you're retired in 06, before the recession happened and the stocks get tank, you could have 2 years of where you can pull out 10 or 8 or 7% and your portfolio would do fine, right? So you can defer income and take during the good years, right? We're making that on average. And then when, let's do the rest of it here. And then when 08 comes around, okay, the market's down. We can't keep taking because it's just going to destroy our portfolio. So therefore, let's turn on Social Security. And that's what we do. So you'd have 2 good years. And then, so at 64, you would turn it on, right? And then we can use another example. Let's look at something. So let's look at 2010. If you retire right after the recession, and we can think about here a great bull run in the market. It averaged 13%. So in theory, and if you retired in 2010, and right, we need 8 years. We need to get to 2018. Let's just do that right now. We need to get to 2018 to defer Social Security and get that twice as big of a payment. It made on average almost 12%, 11.5% a year. So you can pull a ton out of your portfolio, right? If we use the example of $80,000, which let's say for $1 million is 8%, okay, and made over 8%. So you can pull your whole 8% out of your portfolio for 8 years and you'd be fine. And then in 2018, when you did turn 70, you would turn it on. So if you retire in a good market and everything's going well, you keep deferring until you basically hit a bump in the road, and then you turn on Social Security. So a little more thought there, but I think that can provide definitely some benefits and give you options, right? Next, using a withdrawal strategy like a 3-bucket strategy, just so if maybe you have a irrational fear of the market, putting 7 to 10 years of income on the side, maybe in less risky assets or things that are uncorrelated to the stock market, could help you weather the storm, right? So if we go through 08 and it's down for 5 years and it takes 5 years to recover, well, if we had 5, 7, or 10 years of our portfolio on the side, not in the stock market, we could use that money so we don't have to draw from a down market and basically sell at a discount, right? So that can give you some sort of comfort in retiring and thinking, oh, there's a recession right around the corner. You can build up kind of the stockpile and feel safe going into it. And then number 5 is, in general, having a flexible spending plan, right? If the market goes down, if you're willing to reduce your expenses even somewhat, then you can really save your portfolio in the long run, right? So if you say the market's down, or right, we build you a dividend portfolio and you're down 20 or 30%, well, of income, right? So your income has dropped. Could you at least drop your expenses by 10%? So then we don't have to sell as much or different things like that. And that kind of allows overall for you to have a much better retirement and actually be able to withdraw and spend more long term if you're willing to cut back occasionally. But that is all right now. So if you have any questions, please let me know, and take care.